My name is Jake. Welcome to the channel. Happy New Year's, everybody. Welcome to 2021. I'm sorry that I didn't upload a video last week. Last week was a crazy week. If you watched my last video, my wife and I, we just recently moved into a new home. We rented out our old home. We spent 3 days cleaning it, preparing it. Like, I kid you not, it took an entire day just to clean the windows. Like, they weren't even that dirty. It was crazy. Like, I got up on the roof and, on the garage roof and it was an insane time. I'm really, really excited that we got it rented out. And, dividend investing, it's weeks like last week that remind me how much I love dividend investing for passive income, for cash flow. You can invest into real estate or other avenues to generate passive income, but in my opinion, the truest form of passive income is really through dividend investing. And that's my personal opinion. In today's video, I want to talk about my real estate investment trust portfolio. A couple of weeks ago, I went and I broke down my cash flow portfolio in detail, and I'm going to do that in this video for my real estate investment trust portfolio. It's a much smaller portfolio, and I'm going to share my thoughts on real estate investment trusts, why I invest in them. I'm going to also share a few things to consider if you're looking to invest into REITs. There's definitely some pros and cons from a taxation standpoint, but for the most part, just really this video is going to break down my thought process around investing into real estate investment trusts. Towards the end of the video, what I want to do is I want to roll out a dividend reinvestment calculator for all of you. I know a lot of you are probably coming up with your New Year's resolutions, right? You're thinking about 2021, you're thinking about your investing goals, and I want to roll out very briefly a dividend reinvestment calculator that I put together and kind of share that with all of you. And then in a later video, go into detail around the psychology or the mindset around using a calculator like this. I've searched the internet for months looking for a dividend reinvestment calculator that's really accessible and it works for my goals as a dividend growth investor. And I haven't really been able to find one that really, really works for my needs. And so I put one together and I'm going to share it with all of you for free. I know a lot of channels out there, they try to monetize and sell their calculators or stuff like that. Hell, I'm just going to give it to you for free. I spent the day yesterday putting it all together, making it look all nice and pretty with the formulas and everything. I'm going to give it to y'all. You can access it. You can click on the link in the description below. It's not an affiliate link. It's to a Google Sheet. You can make a copy of it and you can play around with the numbers, and hopefully a lot of you that are following the channel will get some value out of that. Well, 2020 brought a lot of surprises, and for my wife and I, we also got a really big surprise in our personal lives, and I'm really happy and excited to share with all of you that my wife and I, that we're expecting a little baby boy here next April. And just thought I would share that with you. I think, having kids can have a major impact on your finances. And I'm really excited to talk about how having a child or having a family is going to impact our journey to financial independence. I have to admit, when my wife told me that we were having a baby, my first reaction was a little like this.
You are going to be, is Daddy having a baby? No. Are you? No! What?
My wife and I, we're both in our mid-30s and we're looking to retire in our early 40s. I've shared on the channel in previous videos that we're looking to amass a $2 million portfolio, and we're doing that with 3 different accounts. The first account is the cash flow portfolio here with M1 Finance. We also have a second portfolio, a real estate investment trust dedicated portfolio. We also have an account with Vanguard where we hold other dividend stocks. The great thing with M1 Finance is you can have multiple accounts or sub-accounts with one login. When we have our baby boy this year, we're going to also create another account where we start investing on a monthly basis for, college, for travel, for cars, whatever it may be, so that we can start saving and investing for a little baby boy. You might be asking yourself, well, Jake, why do you have real estate investment trusts in a different portfolio? And the simple answer is, it's just a personal preference. I see this as a separate or side project. It really doesn't make a difference if you have it in one account or 2 accounts. I personally have it into 2 because I view it separately. And that's really the only reason why. So if you might be thinking to yourself, okay, well, do I need to do this as well? No, you don't. I just do it because that's the way that I personally do it. It's the way that my brain works. I like to think of them as separate projects. With M1 Finance, it's really cool. They're coming out with a lot of new things, a lot of new features, and I absolutely love it. I've tried many different brokerages from TD Ameritrade, from E-Trade, Fidelity, etc. As a dividend investor, I absolutely love M1 Finance. And every January, every year, they have new incentives if you want to sign up and create an account. I think right now they have, if you recently signed up or in the next 90 days, they're going to give you the first year of M1 Plus for free. I think it's like $125. And if you're interested in that, you can check that out. If you already have M1 Finance and you don't have it, I would recommend checking it out. M1 Plus is really great. You get better interest rates on M1 Borrow. You have 2 trading windows a day. It's kind of cool. You're going to see a lot of similarities in the way that I have the account structured, set up, from the transfers to the overall allocation of the portfolio. In the portfolio here, I have it more skewed towards dividend ETFs. I personally like I like making my portfolio as passive as possible. And with ETFs, I find that I can make it a little bit more passive. And with REITs, they're a little bit more volatile, in my opinion, compared to like a Procter & Gamble, a Johnson & Johnson, or a McDonald's. I think REITs are traditionally just a little bit more volatile. And therefore, I try to focus more on quality and really have a targeted approach with how I have the portfolio set up. Okay, so before we dive into each individual slice, I want to briefly share, how I have it set up. I have the automatic transfer set up just like the other portfolio, where I'm transferring over a little over $100 every single week. Every week, I'm transferring over money from my bank account from my 9-to-5 job into the portfolio. And by having the auto invest set up in M1 Finance, every single week, I'm transferring from my bank account and I'm automatically purchasing into my underweight holdings in my portfolio. In addition to the transfers, I'm also getting dividends, organic growth from the companies, and it's building up my portfolio. We talk about that snowball effect, that compounding effect. That's what I'm talking about, where I'm investing into the portfolio, but they're also growing organically. So for example, if you take a look here on December 30th, we got a dividend from the Vanguard REIT ETF, VNQ, as well as Public Storage. All right, so just under $50 from VNQ. And then here on December 31st, in addition to my $25 transfer, it bought holdings into the portfolio for a total value of $76.09. From that, the portfolio invested into the following holdings. These holdings here are underweight based off of the target allocation in my portfolio. If you recall, we got a dividend from VNQ. But because the other holdings in my portfolio are underweight, M1 Finance automatically invested into the other holdings into my portfolio. And that's what I absolutely love about it. It's not a traditional drip. In a traditional drip, for example, in my Vanguard account, I have VNQ in my Vanguard, in my Roth IRA. And the way that that works is the dividends that I got from VNQ were automatically reinvested only into VNQ in my Roth IRA. With M1 Finance, regardless of account type, Roth IRA, individual, it's reinvested into your underweight holdings. And that's a huge difference from a Vanguard account, a Fidelity account, a Schwab account. Very, very different. And that's why I absolutely love M1 Finance. If we look at the total holdings in my portfolio, real estate investment trusts have been hit pretty damn hard here in 2020. Now, a lot of them have recovered, but they're still lagging behind the S&P 500. Real estate investment trusts, depending on which sector you're invested in, were hit very, very differently. For example, in hospitality and leisure, those REITs were just hammered, and they were forced to cut their dividend, in some cases suspend their dividend. Like, it was a really rough year for a lot of companies. The highest performing holdings in my portfolio that I have currently are Store Capital and Omega Healthcare Investments. Now, this has to also do with the timing of when I bought into these holdings. Once again, I've had the portfolio for a little over a year now, and so these are the highest performing based off of the share price that I purchased into them. This doesn't necessarily mean that they're the highest performing for the year, for example. The lowest performing in my portfolio are, FRT, which is really interesting, right? So you look at FRT, and we'll get to this in a second. FRT and STORE are both retail REITs, but they performed fundamentally different. So really, really interesting, and we'll get to that in a second. The next holding here is LTC. This is a healthcare REIT. WPC, American Tower, Realty Income, and Stag are the ones that are down in my portfolio. And as you can see, like the portfolio value, it's minimal, right? It's all relative. Compared to my other portfolio, it's substantially lower in the value, the total market value compared to the other portfolio. But you can see from a percentage basis where these are kind of at. Before we dive into the individual slices of my portfolio, I think it is so important to briefly explain what the different sectors are in real estate investment trusts. Similar to your traditional sectors, you got, you got healthcare, you got materials, you got technology, etc. In real estate investment trusts, it's very similar where they have different sectors. The first sector, for example, here with office REITs, you can buy real estate investment trusts or companies that specialize in office buildings. You can invest in companies that are invested into industrials. They have warehouses. You can invest into companies that own retail buildings, malls, shopping centers. You can invest into companies that hold, hospitality or lodging, hotels. You can invest into companies that are specialized in apartment buildings. You can also invest into timberland REITs, companies that own forests and monetize that. You can invest into companies that are invested into healthcare that own, healthcare office buildings, right, where they own specialized full service care, housing for the elderly. You can also invest into self-storage units. You can also invest into companies that are specialized in infrastructure, cell towers, for example, or companies that specialize in data centers, or you can even invest into some companies that have a diversified portfolio that have a mixture of, a few different sectors. You can also invest into companies that are specialized in the entertainment sector, for example, and you also have mortgage REITs that are focused just on the mortgage-backed security, not the actual physical real estate, but the mortgage itself. It's very important that you understand that each of these sectors are going to perform differently depending on the economic cycle that we're in. And similar to your traditional sectors, some of these sectors are more recession-proof than others. For those of you that have been following the channel, you know that I'm pretty conservative when it comes to my investing. I don't like to take a lot of risk. I really prefer the slow and steady approach to wealth. In my portfolio, I have it set up where I'm focused more on ETFs. When it comes to real estate investment trusts, I see these as really a little bit of a riskier investment than a Procter & Gamble, a Johnson & Johnson, a McDonald's, for example. Real estate investment trusts, they typically have a higher current yield. Not always, but a lot of them do. And in my opinion, they're very cyclical. A lot of real estate investment trusts are forced to cut their dividend because they're over leveraged when times are bad. A lot of REITs here in 2020 cut their dividend. There's a few that didn't, but a lot of them did. And in my portfolio, I'm a big fan of making it as passive as possible. That is why I have 70% of my overall portfolio here allocated to ETFs. I really like making it passive. I have 70% allocated to ETFs. I have 5% allocated to data centers. I have 5% allocated to industrials, 5% to self-storage and also specialties. I have 4% allocated to retail, 3% to diversified, and 3% to healthcare. The first slice is made up of 3 ETFs. The first holding that I have is from Schwab, SCHH. The second is in USRT from iShares, and the third is from Vanguard in VNQ. All 3 of these, there's going to be some overlap. There's only roughly 200 real estate investment trusts in total. So obviously, if you hold an ETF or multiple ETFs and individual REITs, you're going to have overlap. But when you look at the strategy or the approaches of each of these ETFs, they have a little bit of a different approach in how they hold the holdings. So for example, Schwab and VNQ, the sector allocation is very different. So yeah, there's overlap, but it's skewed in different ways. Okay, and so that's why I have 3 of these ETFs in my portfolio. And most importantly, these ETFs have a lower expense ratio. A lot of REIT-focused ETFs or mutual funds or index funds, they typically have a high expense ratio. I have these three in my portfolio mostly because the expense ratio is so low compared to their peers. When looking at these ETFs, the average starting dividend yield is around 3.5%. Now, obviously this fluctuates every single day depending on the share price, but on average, you're gonna get about a 3.5% dividend yield. Now, you can invest into real estate investment trust ETFs and get a 5, 6, 7%, but they're gonna be invested into more riskier assets, right? We talked about that. Now, not every single REIT is equal. Like there's some that are riskier than others. And also you're going to have a higher expense ratio with those other high dividend ETFs. That's at least what I've noticed. So for me personally, I prioritize low fees and sustainability. I want to make sure that, I'm focused on the dividend growth of my REIT portfolio. Now let's take a look at the next slice here in data centers. With data centers, I personally like DLR and EQIX. Digital Realty Trust and Equinix are my personal favorites. There's some other really good data center REITs out there as well. But for me personally, I like having these two. And now you could ask yourself, well, Jake, there's some other great ones out there. What about those? A lot of them are really good. I like, focusing on just a few, and these are my two favorite in the space. When it comes to data center REITs, you're gonna have traditionally a lower starting yield. These are the most hyper growth REITs out there. So you're going to have anywhere from around a 2, maybe a 3% dividend yield, but generally you're going to have a lower starting yield. They're valued much higher like a growth stock than a value stock. So very, very important to understand that. Now let's take a look at the industrial slice here. With industrials, I really like Prologis, ticker symbol PLD. I also like Stag Industrial. Stag is a really good, in my opinion, monthly dividend REIT. It pays a dividend on a monthly basis. It's one of the few that I really like when it comes to monthly dividend payers. With industrials, you're gonna have the starting dividend yield is gonna vary, but it's not gonna be astronomically high. It's also not gonna be incredibly low. I really like investing into industrials because when looking into the future, I see us getting away from brick and mortar retail and transitioning more into the future into the e-commerce space. And there has to be warehousing. You have to store all of these packages, and industrial REITs are solving that problem. And that's why I'm a big fan of industrial REITs. It's not one of those that is, reached its peak in maturity. It's going to continue to grow. I can imagine not only in my lifetime, but for generations to come. Let's take a look at the next slice here in self-storage. When it comes to public storage or self-storage, this is a really boring business model, right? It's very straightforward. It's very predictable. It doesn't grow in double digits every single year, but it's growing. It has a good, healthy, steady dividend. And when it comes to economic downturns, for example, during the financial crisis, public storage or self-storage units, they didn't drop nearly as far as other sectors within real estate investment trusts. I'm a big fan of public storage and extra space storage. Now let's take a look at specialty REITs here. In specialty REITs, I have 2 cell tower REITs in American Tower and Crown Castle International. I think these are both great companies. I think there's a great future for both of these companies, and they're more focused on growth. So if you're in your early 20s, this would be a company, or this sector would be a sector that you would want to invest in more than, for example, a public storage or a self-storage, because these are growing significantly faster, kind of like your data centers or your industrials. Now let's take a look at the next slice here in retail. A lot of you watching the channel, when you think of real estate investment trusts, a lot of you think typically about retail, right? Because it's up in your face. You can see the Walgreens, you see the CVS, you see the Target, you see all of these shopping centers, right? From Simon Property, and you can see them. You drive by them on the freeway, right? They're up in your face. You don't typically see a warehouse or a cell tower or a data center, right? But you see these. And typically when we think about REITs, we think about retail REITs, but there's much more than just retail. So it's very, very important that you don't just overweight your portfolio into retail, because there's so many opportunities out there when it comes to investing into real estate investment trusts. The three that I have in my portfolio, I have Realty Income, Federal Realty Investment Trust, FRT, and I have Store Capital. As you can see, they've all performed very differently here in my portfolio here in 2020. Now let's take a look at diversified here. The two that I have in this slice are Good and WPC. And in my opinion, I like these. They're a little bit more conservative when it comes to their portfolios, the sectors that they're involved in. They're not so much involved in the cyclical sectors where, if you have a market downturn, they're going to be hit harder. They're a little bit more conservative when it comes to their investments. And I value that as a dividend growth investor. I'm looking for that steady cash flow. I'm not looking for my investments to increase their dividend one year, decrease it another, and then increase it. I don't want that roller coaster as much as you would see with other sectors in REITs. So these are my two favorite diversified real estate investment trusts. Now let's take a look at the last slice here in healthcare. Now, if you've been following anything in the news with the virus here in 2020, healthcare just got annihilated, right? Healthcare companies, in the first half of 2020 were just destroyed, right? You look at Ventas, for example, there was talks that they may even go bankrupt, right? A lot of these companies, they were under a lot of pressure. And when it comes to healthcare, they're not growing. The healthcare sector is not growing near as fast as your data centers or your industrials, but I really like having them in the portfolio, especially as the baby boomers start to retire, right? Healthcare costs are going up. A lot of these services that the baby boomers are going to be relying on, I think the healthcare sector REITs are going to benefit from that. It's not something that's going to see hyper growth here in the next year or two, but over the long term, I see the healthcare sector only going up. And my favorites here, I really like LTC, I like NHI, I like OHI from Omega Healthcare, Ventas, and Welltower. These are my favorite healthcare real estate investment trusts. I really like investing in a real estate investment trust. I think it's a great way to diversify your portfolio, get exposure to real estate, and it's incredibly passive, right? We talked about this with, if you own physical real estate, the barrier to entry is much higher. It's a lot more manual work, especially if you're going to do it yourself. It's illiquid. With real estate investment trusts, they're traded on the open market. They're liquid. There's other ways that you can invest into real estate. I've started investing into Fundrise. I've done a lot of research on Fundrise and similar companies to invest into real estate. I'm trying it out. I think, it sounds promising. For me, it's if I had the choice of only choosing one, physical real estate investment trusts, or Fundrise, I think it doesn't have to be an all or nothing. And that's exactly what I do. I invest into all three. I think physical real estate has its benefits, especially the tax benefits. The real estate investment trusts, they're so passive. I absolutely love it. And with Fundrise, it's more of a long-term investing approach with real estate. I really like Fundrise because it's a hedge against inflation. I don't have to do anything. It's incredibly passive, but like I mentioned, it's a little bit less liquid. So for me, investing in a real estate investment trust, those are all the benefits. There's pros and cons with every approach. But for me, for your average person, I think most people would be better off if they want to first start investing and get exposure to real estate. Definitely take a look at real estate investment trusts and focus on quality. One of the things that I love so much about dividend investing is forecasting and looking into the future and seeing how my portfolio can potentially grow over time. I've really looked on the internet to try to find a good dividend reinvestment calculator, and I haven't been able to find one. There's a few different websites out there that work fairly well, but they don't really offer exactly what I'm looking for when it comes to breaking up the capital appreciation, the dividend growth, and the current yield and annual deposits. And so I put this spreadsheet together. It's a dividend reinvestment calculator that I'm using to forecast and predict how long it's going to take for my wife and I to accumulate enough in annual cash flow or dividends so that we can retire early. If you've been following my channel, you know that I talk a lot about time horizon. And it's so important that you understand your time horizon and then you optimize your investments so that they meet your goals, right? So my wife and I, we're looking to build a $2 million portfolio. That's going to be our vehicle, the vehicle to get us to early retirement. So we know within the next 8 to 10 years, we would like to retire. So then what we need to do is we need to understand, okay, how much do we need to be investing every year? And what are the type of investments that we need so that we can meet our goals? And this calculator is going to serve exactly that purpose. So right off the bat, there's a few things that you have to notice. The fields that are in yellow are the only fields that you need to update. So your initial investment is what you have today, and your annual deposit is what you're predicting you're going to invest maybe on, on a monthly basis, weekly basis over a 12-month period for the entire year. The capital appreciation is separate from the dividend growth. You can scroll down here below. I leave little asterisks here in terms of what it means for capital appreciation, how to calculate that, whether with individual stocks or ETFs, as well as dividend growth, how you can calculate the dividend growth. It's important to understand that, as share prices go up and down, this is a moving target, right? It may be a 3.5% today, maybe tomorrow is a 3% or a 4%. Prices are always going up and down. And as always, everybody, it's so important to understand that when planning and forecasting future returns, understand that past returns, historical returns, are no guarantee of future returns. So when you're playing with this calculator here, you're going to put your initial investment, so what you have in your portfolio today, and you're going to put in the annual deposit, that annual deposit, what you're going to be investing in 2021, the capital appreciation of the investments, once again, not including the dividend, the current yield, and the dividend growth. Okay, and all you have to do is update these yellow fields, and the entire chart here and the graph over here will automatically adjust based off of the columns here in yellow that you have adjusted. So for my wife and I, what we like to do is when we know that we want to retire within the next 8 to 10 years, right? And we see, okay, well, I can't live off of $21,000 in 10 years. That's just not feasible for me. So I have to do one of two things. I either have to push out the retirement date to maybe 15 years or 20 years, or I need to play with the numbers. I need to either invest more money, right? We talk about investing. Well, how do I invest more money? Well, I got to cut my expenses, I got to cut my consumer debt, and I have to make more money. Those three things, remember? Full circle. And I also have to adjust the type of investments that I'm invested in, right? So if I know that I'm going to retire in 8 years, I need maybe a higher starting yield. Let's say, for example, you're in your 20s and you have more time, you have 20 years, then you can play around and you can invest into companies that have a lower starting yield, but they're growing their dividend exponentially faster. And that's how you can calculate, how much you're going to make and in what time horizon. You'll notice here on the bottom that there's 3 different tabs. The first tab is with dividends reinvested. This is just a generic 30-year dividend reinvestment calculator with the dividends always being reinvested. The second tab is a little bit different. This is more so for my wife and I. This is living off of your portfolio in the future. So what this portfolio is looking at is you're reinvesting the dividends for 10 years, and then you're no longer reinvesting the dividends and you're no longer investing into the portfolio, but rather you're living off of the portfolio. And if you want to update this from 10 years to, let's say, 15 years or 20 years, all you have to do is update column D here, and that will update your time horizon. And so with my wife and I, what we're looking at is we're looking to retire in, the next 8 to 10 years. So we're growing our portfolio for the first 10 years, and then we're going to no longer reinvest the dividends. We're going to no longer add capital to the portfolio. So you'll see the portfolio will start to grow slower, but this is the organic growth, right? This calculator, this is looking at living off of the portfolio based off of a goal or a time horizon of 10 years. And as I mentioned, you can adjust and change the time horizon. And as I mentioned, I've looked for months for different calculators out there. There's no calculator out there that I know of that has a function set up in this way where you're forecasting and your time horizon of 10 years, and after then the 10 years, what does your portfolio look like, right? Because it's still growing, and this will do it for you. The last tab here is living off of your portfolio today, right? So for example, my wife and I, we want to live off of our $2 million portfolio. Our target, current yield is around 3.5%, capital appreciation of around 7%, and dividend growth of around 8%. What it would look like once we reach early retirement, right? We're no longer reinvesting the dividends. We're no longer adding capital to the portfolio, but what will our cash flow look like? When you look at the growth of the portfolio and you look at the power of compounding, at first, when you look at these numbers on the right, it's like, holy cow, this is just almost unbelievable, because it's hard for our brains to even fathom what it could look like and the potential growth if we were to invest in this type of strategy. When I showed this to my wife yesterday, and I said, hey, look at this. Once we retire, we're still going to be making more money each year. And I said, 10 years after retirement, we're going to nearly double what we had when we first retired without having to do anything. And she looked at me and she's like, wait, are you serious? And I could see in her eyes that light bulb, that the light went on, and she's like, holy cow. And she understood, in that moment, I could see that she understood the power of compounding. So everybody, this is why I invest for dividend growth. This is why I invest and want to retire off of my dividend growth portfolio and not follow the traditional 4% rule of the FIRE movement. Now, the numbers here in the top left are all relative. They all depend on your expenses. They depend on how much money you're going to need in early retirement. But this calculator is going to help you to forecast and predict what you need to invest every single year to reach your goal. When it comes to predicting your time horizon and planning for your future, working with the dividend reinvestment calculator is so important, because it makes it a reality. It helps you understand and identify gaps. For example, if you're not investing enough or you're investing too conservatively for your time horizon, you either have to adjust your time horizon further out or adjust, some of the numbers. And for all of you dividend nerds out there that love working with numbers and, engineering, your retirement, this is for all of you. Thank you so much, everybody, for watching the video. If you're new to the channel, I'd invite you to subscribe. We're over 20,000 subscribers. Thank you so much to every single one of you. If you liked today's video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.